Five systems breaking down simultaneously: valuations, monetary policy, credit, retail leverage, and the macroeconomy, all flashing red right now at the same time. This is not noise. This is a convergence signal. Let's break it down. Welcome back to the market thesis. Today's analysis is a structural warning on the S&P 500 and Nasdaq. I have identified five independent risk pillars that are converging at the same moment. And when you see this kind of alignment, history says it doesn't end quietly. Let's go layer by layer. Valuations disconnect. Pillar 1: Valuation. Forward P is sitting at 22 multiples. That alone isn't alarming. But look at what's happening to the denominator. Forward earnings estimates are being revised down actively in the real time. That gap on the chart between S&P 500 and where the forward earnings are heading, I call it the fundamental void. Prices are reflecting macroeconomic perfection, the data is showing active deterioration. When prices and fundamentals diverge this hard, one of them has to move. There is no earning recovery catalyst visible on the horizon. That means the correction risk is directional and it's downward. Pillar 2: The safety net. Markets have operated for years with the implicit assumption: if equities crack, the Fed cuts injects liquidity. That backstop is gone. Look at where we sit on the policy trap matrix. Sticky inflation matrix, limited policy runaway. The market is pricing in rate cuts that the inflation data fundamentally prohibits. The Fed cannot ease into sticky inflation without reigniting it, which means if this market cracks, the central bank has virtually zero room to absorb the shock. The backstop that bailed out every correction since 2009 is no longer available. That changes everything. Pillar 3: Credit warning. Pay close attention here. Credit leads equities. Always. This historical analog overlays puts late 2007 next to the current environment side by side. In 2007, equities ignored widening high yield spreads right up until they couldn't. Today, same pattern. S&P 500 elevated, high yield credit spreads quietly widening, default rates quietly rising. This is the exact architectural fingerprint that precedes major equity liquidations. Credit markets are not speculating. They are telling you something that equity prices haven't priced in yet. Retail exhaustion. Pillar 4: Sentiment and positioning. Three inputs, all at simultaneous extremes. Options market. Extreme call skew. The crowd is positioned overwhelmingly for upside. Margin debt, 99th percentile historically. Retail participation cycle is very high. This isn't confidence, it's crowding. And leveraged crowding has a mechanical consequence. When prices pull back, even modestly, the margin call unwinds, becomes the accelerant. Post selling feeds more selling. This is how corrections become crashes. Not from a single catalyst, but from the positioning that was already in the place where it arrived. Macro deterioration. Pillar 5: The real economy, and this is the domino effect in real time. Manufacturing PMI at 48.1, contraction, industrial production down 2.4% year on year. New orders declining, that feeds into the consumer savings rate at 3.1% at a critical low. Excess savings exhausted. Real disposable income is stagnant. Result: multi-year high delinquencies. Credit cards up 21% year over year. Auto loans surging, late payments accelerating. The consumer has been operating on fumes. And the consumer that is mixed out of the The client cannot sustain the revenue base justifies 22x earnings multiples. The core economic engine has stalled. Five pillars, all converging. So, what do you actually do? Rotate aggressively out of high tech beta stocks. Extreme valuations with falling EPS is not where you want exposure. Move into the short duration T bills as cash proxy. You get yield and optionality. Avoid high yield fixed income. Credit spreads widening means high yield is the first casualty. Hedge tail risk with weak call spreads. Buy the insurance before you need it. And overweight consumer staples and non-cyclicals. Real cash flow, cash independent. The principle that ties this all together is the preservation of capital must not supersede the pursuit of yield. The data is showing you the crack in the real time. The peak always look obvious in hindsight. If this gives you the clarity, like, subscribe, drop your positioning in the comments. This is Market Thesis. See you in the next one. Thank you.